What if the secret to long-term wealth was written in a 1982 letter by Warren Buffett? Not a tweet, not a tip, but timeless wisdom. That's more relevant to Indian investors today than ever before. In this series, we break down 15 powerful lessons in simple language so that even a new investor can invest like a business owner. Let's begin. Lesson 1. Don't be fooled by reported profits. Look at economic reality. Accounting earnings can seriously misrepresent economic reality. Warren Buffett said, "Accounting numbers are the beginning, not the end, of business valuation." Let's break this down. Imagine you invest Rs 1 lakh in your friend's business. At the end of the year, he gives you Rs 5,000 as profit. That's visible in accounting. But he also reinvests Rs 20,000 to grow the business, buying tools, hiring people, expanding operations. This Rs 20,000 doesn't show up in your profit, yet it builds your future wealth. That's what Buffett wants you to understand. Reported profits may hide the true economic value being created underneath. In 1982, Berkshire Hathaway owned 35% of Geico. Geico paid $3.5 million in dividends but retained $23 million in profits, quietly building long-term value that didn't appear on Buffett's income statement. In India, think of Bajaj Holdings, Tata Investment Corporation, or Mahindra Holdings. Their profits look small, but they own strong businesses, compounding quietly in the background. So, as an investor, here's how you apply this. Don't rely solely on net profit or dividends. Look for retained earnings and how they're being used. Track the long-term growth in intrinsic value, not just short-term numbers. Buffett's golden question is this: if I own just 0.01% of a company, am I gaining value, even if there's no dividend? If the answer is yes, then you're not just a shareholder. You're a real business owner. Lesson 2. Buy wonderful businesses at reasonable prices, not average businesses at cheap prices. Warren Buffett once said, "Our job is to select businesses with economic characteristics allowing each dollar of retained earnings to be translated into at least $1 of market value." In simple terms, don't fall for cheap stocks. Instead, buy high-quality companies that know how to grow value from their profits. Let me explain. Imagine you plant 2 mango trees. Both start the same. One grows 10 mangoes a year and reinvests to grow more next year. The other also grows 10 mangoes, but reinvests badly, grows only leaves, no new fruit. Same profits, totally different outcomes. It's the same in investing. A company might retain Rs 1 crore in profits, but if that leads to Rs 2 crore in added market value, that's a wealth-building machine. But if it retains Rs 1 crore and only adds Rs 50 lakh to value, the money is being wasted. So what should Indian investors look for? Practical checklist: ROE and ROCE. Check return on equity and capital. Is it consistently high? Retained earnings. Look in the balance sheet. Are reserves leading to business growth? Market cap versus earnings growth. Over time, is market cap growing as fast as retained profits? Let's take 2 examples. Asian Paints retains profits and reinvests in brand, distribution, and innovation. Result: strong growth, rising market value. But some PSU banks retain profits, give low returns, and reinvest inefficiently. Result: little to no shareholder wealth creation. Red flags to avoid: companies with high profits but no improvement in share price or value. Businesses that hoard earnings but don't use them wisely. Cheap stocks that look attractive but destroy capital over time. Buffett's golden rule is this: it's better to buy a great company at a fair price than a mediocre company at a cheap price. In Indian markets, this mindset separates the investors who get rich slowly from those who lose fast. Lesson 3. Price is what you pay. Value is what you get. Here's a classic Warren Buffett line: price is what you pay. Value is what you get. Don't be fooled. A high stock price doesn't always mean quality, and a low price doesn't always mean a bargain. Let's simplify this. Imagine you're buying a taxi. Both taxis earn Rs 50,000 a month, but one costs Rs 5 lakhs and the other costs Rs 10 lakhs. You pay twice as much for the same income. That's exactly what happens when you overpay for a stock. Even if the business grows, your returns shrink, because the entry price was too high. Buffett warns, a great company bought at a bad price becomes a bad investment. How this applies to Indian stocks. Many investors get excited about big brands, DMart, Titan, HDFC Bank, and buy them at any price. But even these wonderful businesses can give poor returns if you pay too much up front. Let's break it down further. Checklist before buying. Check valuation multiples. Look at PE, PB, or EV/EBITDA. Compare with historical averages of the same stock. Growth versus valuation. Are you paying 80x earnings for a company growing at 15%? That's overpaying. Look for a margin of safety. Buy when stocks are undervalued or fairly priced, not during hype or FOMO. Ask yourself, am I buying a business or just a price trend? Examples. DMart is a superb retailer, but if you buy it at 150x earnings, even 10 years of growth won't give you great returns. On the other hand, companies like Kera Sanitaryware traded at fair valuations and rewarded long-term investors handsomely. Red flag. Avoid the trap of chasing popular names without checking valuation. Even the best business can hurt your returns if the price is irrational. Buffett's timeless lesson, don't just ask what's the price. Ask what am I getting in return? That's how you invest with clarity, not emotion. Lesson 4. Small investors can outperform. Use market mood to your advantage. Warren Buffett says, stock prices are often driven by emotion, not logic. That's your advantage. You see, the market isn't always rational. It swings between extreme fear and overconfidence, just like human emotions. Imagine a busy vegetable market. Vendors shout wildly. Some panic and sell tomatoes cheap. Others get greedy and demand high prices for the same tomatoes. Now here's the magic. You, the buyer, can choose when and from whom to buy, based on your price. The stock market is just like that. Every day, it quotes prices for quality businesses, sometimes too high, sometimes unfairly low. As an investor, you don't need to follow the crowd. You just need to wait patiently and buy only when the price is right. Buffett's wisdom. Think of stocks as ownership in real businesses, not lottery tickets. Thanks to the stock exchange, you can buy even 0.01% of India's best companies at a price you choose. Practical use for Indian investors. Use market panic to your advantage during market crashes, like COVID in 2020 or IL and FS in 2018. High-quality stocks like Asian Paints, Bajaj Finance and HDFC Bank were trading at massive discounts. That was the time to act, not panic. Avoid crowd behavior during bull runs in hot IPO seasons or bull markets. Most people rush in, buying overpriced stocks because everyone is buying. That's when you need to hold back. Ask like a business owner. If this company were private, would I still buy it at this price? If not, stay away. Examples. Yes Bank, 2018, looked cheap, but the business was deteriorating. That was a trap. Tata Consumer, 2020, was ignored by the market, yet it was improving under new leadership. A hidden gem. Superpower of small investors. Institutions manage crores. They move slowly, but you can move fast, go small, and act independently. That's your edge. You can invest Rs 10,000 in undiscovered stocks. Stay out of the market when valuations are frothy. Move quickly when others are frozen in fear. Red flags to avoid: overreacting to short-term news or crashes. Chasing hype just because stocks are trending. Forgetting that stock prices and business value are not the same. Buffett's winning strategy. Be greedy when others are fearful. Be fearful when others are greedy. The real power is in doing the opposite of the crowd and having the patience to wait. Lesson 5. Not all profits are equal. Focus on how earnings are used. Warren Buffett says, the value of retained earnings depends entirely on how effectively they are used. Let's simplify this with a relatable example. Imagine you lend Rs 1 lakh to two friends, A and B. Friend A opens a pawn shop. He earns profits but reinvests into more pawn stalls. Growth is slow, not much changes over 5 years. Friend B opens a digital marketing agency. He reinvests into better tech, skilled staff, and customer acquisition. In 5 years, his business multiplies in value, dramatically. Both show profits on paper, but only one made your money truly grow. This is the core lesson. It's not how much profit a company earns, but what it does with that profit that matters. Some companies reinvest profits efficiently and create massive shareholder wealth. Others just burn it on poor projects, wasteful expansion, or unrelated ventures. How to apply this in Indian markets? Check ROAS and ROE over time. High and stable return on capital employed means profits are used wisely. Compare retained earnings versus market cap growth. If a company retains a lot but market cap doesn't grow, something's wrong. Look at capex efficiency. Are the rupees spent on new projects generating proportionate returns? Read management commentary. How are they allocating capital? Do they have a long-term plan, or just vague promises? Indian examples. Pidilite Industries reinvests profits into R&D, branding and distribution, leading to consistent compounding. ITC for years invested in hotels and FMCG, but returns were muted despite strong core profits. Beware of illusions. A company may show rising profits, but declining ROAS. That's value destruction. If retained earnings aren't driving EPS or market value, it's a red flag. Always ask, is this company using retained earnings to grow per share value? If the answer is no, then those profits are empty calories. Buffett's wisdom for Indian investors. Don't get excited by net profit alone. Look deeper. Are they reinvesting wisely? Is capital being used productively?
Lesson 6. Beware of empire builders. Not all growth is good. Warren Buffett warns us with this sharp insight. The thrill of the chase blinded the pursuers to the consequences of the catch. Translation: some companies expand aggressively, acquiring new businesses, launching new products, or taking on debt, all in the name of growth. But not all growth is good growth. Let's break this down with a simple example. Imagine you own a 1-acre mango orchard. It's healthy and productive. But then, you trade 25% of it for half an acre of barren land, just to say you've expanded. Now, on paper, your land size has grown, but your fruit yield has dropped, and your ownership is diluted. This is exactly what happens when companies acquire weak businesses, overpay using valuable shares, or take on unnecessary debt to chase size. Buffett calls this empire building, where CEOs focus on expanding their corporate kingdom instead of protecting shareholder value. How to catch empire builders in Indian markets? Check how acquisitions are funded. Are they issuing new shares? That dilutes your ownership. Are they taking high-cost debt? That adds risk. Evaluate past acquisitions. Did EPS or ROAS improve? Or did it just increase complexity? Watch management language. Terms like aggressive expansion or strategic diversification sound good, but are red flags if not backed by results. Indian case studies. LET's acquisition of Mindtree was bold, but raised concerns about price, fit, and integration. In contrast, Page Industries grew slowly and organically, with laser focus. The result? Steady high returns and no drama. Red flags for investors, frequent share issuance, acquisitions in unrelated industries, constant new ventures without improving shareholder returns, promoters obsessed with scale rather than per share value. Buffett's metaphor is sharp. If your family owns a 120-acre farm and you invite a neighbor with 60 acres into a 50-50 partnership, your domain got bigger, but your ownership just dropped 25%. Bottom line, don't get fooled by headlines that say, Company X is expanding. Ask instead, is this expansion improving shareholder wealth? Smart growth is silent. Empire building is loud and often wasteful. Lesson 7. Reported profits can be a mirage. Understand the business reality. Warren Buffett once wrote, "It is possible for an insurer to show almost any profit number it wishes. Weak operations often lead to weak accounting." In simple terms, don't blindly trust reported profits. They can be manipulated, misrepresented, or delayed, especially in financial companies. Let's simplify this with a real-life example. Imagine you run a coaching class. Your income should come from fees paid by students, but instead, you start showing next year's admissions as this year's income. Delay your teachers' salaries and skip refunding dropouts. On paper, Profits look great. But in reality, the business is shaky. This is exactly what some companies do, especially in insurance, NBFCs, and banks. They use accounting tricks, under-provisioning for bad loans, delaying losses, showing one-time gains, recognizing future income as current profit. Buffett's advice: look past the P&L, understand the real economic health of the business. Here's how you can do that in India. Look beyond PAT. Check cash flow from operations. CFO. Is real cash growing along with profit? In banks, NBFCs, watch closely non-performing assets, NPAs, provisioning policies, capital adequacy ratios, changes in loan book quality. For insurance companies, check the combined ratio. If it's above 100%, they're losing money on core operations. Avoid being fooled by one-time gains. If profits spike suddenly, ask, was this from real business, or a sale, tax refund, or accounting shift? Indian examples: DHFL and IL and FS once showed strong profits, but once the real books were exposed, investors lost everything. On the other hand, insurers like HDFC Life and ICC Lombard often disclose their underwriting losses transparently, helping investors trust their numbers. Buffett's pro tip: read footnotes, check auditor remarks, analyze segment-wise performance, not just headline profit. If profits look good, but cash flow is missing, or debt is rising, something is off. Red flags: frequently changing auditors, reporting sudden profit reversals, using accounting changes to show better results, rising profits but falling cash flows. These are signs of cosmetic accounting, not genuine performance. Bottom line, in India's complex markets, trust numbers only after you verify the story behind them. True investors ask, is this profit real, repeatable, and responsibly earned? Don't get dazzled by profit. Chase truth, not just numbers. Lesson 8. Never issue shares unless you're getting equal or greater value. Warren Buffett famously said, "We will not issue shares unless we receive as much intrinsic business value as we give." In his words, why would anyone exchange Rs 100 notes for Rs 50 coins? Now let's understand why this matters so much for you, the shareholder. Imagine this simple story. You own a gold coin worth Rs 50,000. Someone offers you 2 silver coins worth Rs 10,000 each and says, "Here, now you have more coins." You now hold more coins, but less value. This is exactly what happens when a company issues new shares, without receiving equal or greater value in return. On the outside, the company may look bigger, but your ownership percentage shrinks, and often so does your future wealth. This is called dilution. It silently reduces your slice of the pie, even if the pie itself looks bigger. Buffett warns us, don't trust companies that dilute equity carelessly. How to detect shareholder unfriendly dilution in Indian companies. Track the share count over time. Is the number of outstanding shares rising every year? Ask, what did the company gain in return? Did the share issuance fund something valuable, or was it a distraction? Evaluate impact on per-share metrics. After a merger or fundraising, did EPS, ROAS, or book value per share go up or fall? Read the buyback behavior. Smart companies buy back their shares when undervalued. Weak companies buy at peak prices or keep issuing instead of buying back. Indian examples. D-Mart, Avenue Supermarts, rarely issues shares. It grows using internal profits, protecting shareholder value. Zomato, on the other hand, issued massive equity to acquire Blinkit. If integration fails or value isn't created, existing investors pay the price through dilution. Infosys, in the early 2000s, bought back shares at low valuations, a superb capital allocation move that boosted long-term returns. Buffett's golden rule for managers: if you wouldn't sell your entire business at a certain valuation, don't sell part of it by issuing new shares either. Capital is precious. Treat it like it's your own. Red flags to watch for. Frequent equity issuance for vague future growth. Using shares to fund unrelated speculative projects. Rising share count, but stagnant per share value. These are signs of management chasing size, not protecting shareholder wealth. Final takeaway. A smart company grows value per share, not just size or revenue. Always ask, is the company growing my piece of the pie, or just making the pie bigger while my share gets smaller? Growth funded by dilution isn't growth. It's erosion in disguise. Lesson 9. Avoid industries with commodity products and chronic overcapacity. Warren Buffett said it straight. Persistent overcapacity without pricing power equals poor profitability. Let's understand what that means, using a street example. Imagine this. You and 10 of your neighbors open sugarcane juice stalls on the same road. Everyone uses the same machines, same sugarcane, same glass. There's no difference in quality, just the price. So what happens? You start undercutting each other. RS30 becomes RS25, then RS20, and soon RS15. Sales may grow, but profits vanish. This is what Buffett warns against. Commodity businesses with no pricing power. A commodity business equals sign. A company selling a product that customers don't care where they buy from. It could be cement, steel, sugar, paper, or textiles. And when these sectors have too many players or expand too fast, oversupply kills margins. How to spot these in Indian markets? Is the product differentiated? Or is everyone selling the same thing? Is there overcapacity? Are many players expanding production at the same time? Do prices dictate profits? If profits rise only when global or seasonal prices rise, that's a red flag. Are margins volatile? Big profit swings usually mean low control over pricing. Indian examples. Steel stocks like JSW Steel perform well during upcycles, but crash hard in downturns. Sugar and cement businesses are seasonal or policy dependent. Textile and paper companies struggle to build brand or pricing power. Now compare that with a company like Asian Paints, also selling a physical product, but with brand loyalty, retail strength, and pricing power. What to look for instead? Seek businesses with brand value, customer stickiness, supply discipline, pricing flexibility, differentiation in service or experience. Red flags. Buying a cyclical stock at peak profits, valuing companies solely on current low PE during a hot cycle, chasing sectors like sugar, power, metals, or textiles based on short-term rallies. Buffett says, nothing fails like success. When profits peak, capacity explodes, and the cycle turns. Final takeaway. In Indian investing, don't confuse revenue growth with wealth creation. Avoid sectors where profits depend on luck, timing, or price wars. Instead, bet on companies with structural strength, not just short-term heat. If everyone can make it, no one keeps it. Avoid commodity traps. Lesson 10. Don't mistake structural decline for a temporary down cycle. Warren Buffett warns us, the cycle may not return to normal because the business has permanently changed. Many investors make a costly mistake. They assume a falling industry will bounce back, when in fact it may be dying. Let's break this down with a real-life example. Imagine a photo studio owner. For 30 years he prints passport photos and wedding albums. Every few years business slows. He says, it's just a bad phase, it'll recover. But then smartphones arrive. People have cameras in their pockets. They edit photos, store albums digitally. Suddenly, demand disappears. Forever. This wasn't a cycle. It was a structural shift. Buffett saw this in insurance during the 1980s. Pricing power vanished. New competition arrived. The rules of the game changed. For good. How to spot structural decline in Indian markets. Technology disruption. Has a newer, better model replaced the old one? Think of Jio's impact on telecom. Low prices, fast internet, and sudden destruction of older players. Regulatory shifts. New rules may kill old growth models. Like RBI's tightening after the IL and FS crisis, which changed how NBFCs operate. Consumer behavior changes. EdTech boom post-COVID. Many assumed it would last, but Bajaj and others are now struggling because demand was temporary. Margins refuse to recover. If profit margins stay low, despite recovery in sales, the business might be broken, not just bruised. Let us see some Indian examples. Telecom post 2016. Jio entered. Pricing collapsed. Vodafone Idea never recovered. Only Airtel survived. And only after massive reinvestment. Jet Airways. Passenger demand stayed high, but pricing power vanished. Result? Bankruptcy. Traditional EdTech. High valuations didn't survive real-world churn. Buffett's view, managers often deny structural problems. They blame macros, cycles, or temporary factors. But investors must see through the noise. Buffett says, real exits require a shock or collapse. Until then, people keep hoping. Red flags. Businesses blaming the economy for too long, falling margins over years, not just quarters, new age competitors entering with better costs or tech, low pricing power, even during high demand. Final takeaway. Not every fall is a buying opportunity. Some are signs to exit before it's too late. If an industry is structurally broken, no amount of patience will fix your investment. If the game has changed, don't wait for the old rules to work again.
Lesson 11. Great managers run businesses like they own 100% of it. Warren Buffett said this about two retiring managers. They ran the business with the same care and intensity as if they personally owned 100% of it. And that is the mark of truly great leadership. Because here's the truth. A great business can fail under poor management, but an average business in the right hands can outperform. Let's understand this with a simple example. You hand over your shop to two different people. One treats it like their own, tracks expenses, talks to customers, reinvests profits carefully. The other just shows up, takes a salary, avoids responsibility, and leaves early. They don't really care because it's not their shop. Now ask yourself, which one do you want running your company? Buffett says, invest in businesses where managers act like owners, not hired employees. How to identify these owner-minded managers in India? Promoter holding. Is the promoter stake high? Are shares unpledged? Capital allocation discipline. Do they reinvest wisely? Avoid fads and risky expansions. Track record over cycles. Have they navigated both good and bad times well? Communication quality. In annual reports or earnings calls, do they speak honestly? Compensation versus performance. Are salaries reasonable? Or are they overpaid despite weak performance? Dr. Devi Shetty of Narayana Health, known for cost control, ethics, and mission-driven leadership. Vinati Saraf of Vinati Organics, scaled a niche chemical business with R&D and long-term thinking. Siddhartha Lal of Eicher Motors, restructured the company, led Royal Enfield's comeback. Buffett's filter. He avoids businesses that require a genius to survive. Red flags. Promoters constantly pledging shares, frequent management churn. Great companies are built, not just on strategy, but on character. Lesson 12. Understand economic goodwill. The secret behind low capex compounders. Warren Buffett's 1982 letter didn't mention the phrase directly, but the idea shines throughout. He praised companies like See's Candies and Decode, not just for their earnings, but for their economic goodwill. So, what exactly is that? Let's simplify it. Imagine a tea stall. Customers don't just come for cheap tea. They come for the taste, the experience, and the trust. Every year, the owner raises prices by Rs2 per cup, and people still line up. He doesn't need to buy new machines or open 10 more stalls. He just keeps compounding from loyalty. That's economic goodwill. It means the business earns more than it needs to grow. It doesn't require heavy capex to scale, and it builds intangible value, brand, trust, habit, that fuels free cash flow. Buffett loves these businesses because they generate high returns on capital year after year. How to spot economic goodwill in Indian markets. High ROAS with low capex. If a company shows ROACE above 20-25% without needing major infrastructure spending. Hindustan Unilever. It doesn't build factories every year, but because of Lifebuoy, Dove, and Surf Excel, it earns massive free cash. Asian Paints. Strong brand, tight distribution, low working capital, and customers who rarely switch. Capital light equals capital right. Companies that require less capital to grow can pay higher dividends. Red flags. Profits rising, but capex and debt rising even faster. In India, the best businesses scale without sweating capital. Buffett calls them compounding machines. Lesson 13. Don't confuse activity with progress. The virtue of inactivity. Warren Buffett once admitted, "We almost made a terrible acquisition. It would have consumed huge time and energy for a very uncertain payoff." He quoted Pascal, "All men's misfortunes spring from not being able to sit quietly in a room." That's the heart of this lesson. In investing, sometimes doing nothing is the smartest move you can make. Let's illustrate with a simple example. You plant a mango tree. It needs water, sunlight, and time. But what if, out of impatience, you start shaking it every week, cutting healthy branches, overwatering it, or moving it around? Instead of speeding growth, you're destroying it. That's exactly what happens when investors overreact, overtrade, or chase fads. Most wealth in the stock market is created by waiting, not by doing. How to apply this as an Indian investor? Limit portfolio churn. Don't keep switching stocks every few weeks. Let strong companies prove themselves over time. Resist FOMO. Just because a stock is trending doesn't mean you need to jump in. IPO hypes, EV buzz, defense stocks. These trends come and go. Understand the cost of activity. Every trade costs brokerage, taxes, and more importantly, your peace of mind. Learn to sit tight. In downturns, many investors panic and sell, but those who stay calm and hold quality win big in the long term. Investors who held Bajaj Finance through ups and downs since 2010 saw 100x returns. Infosys faced scandals and price dips, but long-term holders compounded steadily. Meanwhile, traders who jumped into every IPO, Zomato, Paytm, car trade, often burned value instead of building it. Buffett's stillness principle, he says, our favorite holding period is forever. Buffett spends 80% of his day reading and thinking, and only acts when there's a clear, compelling reason to invest. Red flags: constantly checking prices, reacting emotionally to news, trading weekly or monthly, switching from great stocks to hot stocks. These are signs of activity, not strategy. Final takeaway. In investing, patience is not passive, it's powerful. Success often comes not from doing more, but from doing less, better. Lesson 14. The double whammy effect. One bad move can hurt value and valuation. Warren Buffett warns, a value-destroying acquisition doesn't just hurt earnings, it also lowers the market's trust in the company. This is what he calls the double whammy effect. Let's break it down. Imagine this. You run a premium coaching center. Parents love it. Results are strong. Reputation is gold. But one day you take a Rs 10 lakh loan to acquire another coaching class, one that has poor teachers and low reviews. What happens? Profits dip because the new center performs badly. And worse, your brand image takes a hit. Parents begin to doubt your judgment. This is the double hit. Your earnings fall, and your valuation multiple drops too. How this happens in the stock market. When a company issues shares or takes debt for a bad deal, intrinsic value falls. EPS drops, ROCE weakens, cash flows deteriorate, market valuation falls, investors lose trust, PE ratio compresses, analysts downgrade. Even if the core business stays healthy, market confidence may never fully recover. Buffett puts it bluntly, even one bug in the salad makes people throw it out. Indian examples. Tata Steel plus Chorus, high hopes, but massive debt and weak global demand damaged returns for years. Bharti Airtel plus Zain Africa, costly, slow returns, and a heavy burden that took a decade to manage. Vedanta plus Cairn merger sparked shareholder protests. The stock suffered valuation damage. On the flip side, companies like Asian Paints and HUL have made only small strategic acquisitions that protected shareholder value. Red flags: big, transformational deals in unrelated sectors. Share issuance that dilutes existing holders. No clear value added after a merger. Falling EPS or ROCE post-acquisition. Buffett's advice to investors. Study management's capital allocation track record. Are they cautious? Do they explain decisions clearly? Are per-share metrics improving after acquisitions? If not, step back. One bad capital decision can undo years of compounding. Lesson 15. You only need a few great decisions. Temperament beats intelligence. Warren Buffett often says, our performance didn't come from genius. It came from focus, discipline, and a few really good decisions, held patiently. This is one of the most powerful truths in investing, because here's the secret. You don't need to be a math wizard. You don't need to pick 100 stocks. You just need to find a few great businesses and let them work over time. Imagine a mango farmer. He plants 4 high-quality saplings in fertile soil. He waters them, protects them, and waits. He doesn't dig them up every season. He doesn't plant 50 more just for excitement. Over the years, his trees grow strong, giving shade, fruit, and wealth. That's exactly how wealth builds in investing, through focus and patience, not speed or complexity. Buffett's own journey? Most of his wealth came from less than 20 decisions over 60 years. Big bets on Geico, Coca-Cola, American Express, Apple. He didn't jump around, he stayed put, and let compounding do the heavy lifting. What this means for Indian investors: avoid over-diversification. Holding 8-12 well-understood stocks is often enough. Don't chase every theme. IPOs, EV, defense, AI, every year has a buzzword, but very few of them deliver over the long run. Think in decades, not quarters. Focus on business potential over the next 10 years, not the next 3 months. Temperament matters more than IQ. Buffett says, once you have ordinary intelligence, success depends on controlling the urges that get others in trouble. Indian examples of simple, long-term success: Asian Paints, held patiently, has created multi-generational wealth. Infosys, Pidilite, HDFC Bank. Boring, maybe, but consistent, focused, and compounding, absolutely. Red flags: constant switching between stocks, measuring success week to week, acting on tips or Twitter trends, trading emotionally during corrections or rallies. Final takeaway: in investing, the game isn't about brilliance, it's about behavior. Choose well, stay calm, let time and compounding do the magic.